You are not driving into a light rain, you are entering a housing market downturn that is already unfolding. Despite headlines promising a soft landing, home prices, real estate inventory, and price cuts tell a different story. This is not a future housing correction in 2026. It is the early stage of a deeper housing market reset happening now. Across the country, national averages hide the damage, but zoom in and you will see cities where equity is vanishing, listings are piling up, and sellers are slashing prices just to attract one serious buyer. In some zip codes, the slowdown rivals and may exceed conditions seen around 2008. Investors are backing away, early foreclosure activity is rising, and once hot markets are going quiet. In today's Housing Watch, we break down 10 cities where the housing floor is giving way. By the end, you will understand why smart money is holding cash and waiting. Before we get started, make sure you're subscribed to Housing Watch and turn on notifications so you don't miss what's coming next. Subscribe for clear, data-driven insight into the U.S. housing market. Your support really helps the channel grow. Tap like, share your local experience in the comments, and buckle up. Now, start the engine. We have a lot of miles to cover. Number 10. Las Vegas, Nevada. We head west into the desert, where Las Vegas rises like a glowing mirage. The Strip is still buzzing with visitors, but once you leave the casinos behind and drive into the vast grid of suburban neighborhoods, the mood changes quickly. Far from Las Vegas Boulevard, quiet streets, darkened homes, and aging for-sale signs tell a very different story. Las Vegas has always been a boom and bust city. When the economy is strong, it thrives. When conditions tighten, it is often among the first to feel the impact. Right now, that pressure is building. Data from the Las Vegas Realtors Association shows that the number of single-family homes listed without any offers is up more than 30% compared with last year. That growing pool of unsold homes is colliding with an economy heavily tied to tourism, tips, and discretionary spending, all of which are under strain from inflation and tighter household budgets. Large portions of the metro depend on casino wages, hotel jobs, and convention traffic. As travel spending cools, the effects show up fast. Hotels and entertainment venues are quietly cutting hours and staffing, and that stress is spilling into the housing market. Mortgage delinquencies in parts of Nevada are now running above the national average, an early warning sign that financial pressure is spreading. Many service workers are scrambling for extra shifts or side income just to keep up with fixed housing costs. Home prices are not collapsing overnight, but the trend has clearly shifted. When adjusted for inflation, real home values are declining. Nearly half of recent sales are closing below list price, a dramatic change from the bidding war frenzy of the pandemic years. Institutional investors are also pulling back. Firms that once bought rental homes in bulk are slowing purchases or selling off portions of their portfolios. What used to be a reliable source of demand has turned into additional supply, putting pressure on prices and rents. For local landlords, that means more competition and fewer opportunities to raise rents, even as insurance and maintenance costs climb. The lights on the Strip still shine bright. But beyond the neon, Las Vegas is once again revealing how vulnerable a highly cyclical housing market can be when high interest rates collide with slowing tourism. Number 9. Tampa, Florida. We start in Florida's Gulf Coast, where Tampa still greets you with sunshine, palm-lined streets, and sparkling water views. Not long ago, this city was one of the biggest winners of the pandemic housing boom. Buyers poured in from across the country, competition was fierce, and prices seemed to climb without pause. That era is over, and the shift on the ground is hard to miss. Cruise through once busy neighborhoods, and you will see for sale signs lingering far longer than they used to. According to recent Redfin data, active listings in the Tampa metro area are up nearly 40% year over year. This is far beyond a typical seasonal increase. It represents a serious buildup of supply at a time when buyer demand is shrinking. Mortgage rates play a role, but Tampa's real pressure point is insurance. Homeowners across the region are being hit with premiums that have doubled, tripled, or even quadrupled in just a few years. Those costs add hundreds or even thousands of dollars a month, dramatically changing the true cost of owning a home. The number shown on a mortgage calculator often no longer reflects reality. For many buyers, deals collapse as soon as insurance quotes arrive. Debt-to-income ratios spike, lenders pull back approvals, and buyers walk away. Sellers are responding fast. Realtor.com data shows that more than 25% of active listings in Tampa have already reduced their prices within a single month. Nearly one-third of sellers are conceding that yesterday's pricing no longer works in today's market. Bidding wars have vanished, replaced by concessions like closing cost credits, mortgage rate buydowns, and other incentives designed to spark interest. Sales volume is down sharply, inventory levels are rising, and the market has clearly tilted toward buyers. Short-term rental investors are also under strain. As vacation rental supply increases, occupancy rates are slipping, turning once profitable properties into cash flow problems. Many of these units are now hitting the resale market, adding even more pressure to prices. From the water, Tampa may still look idyllic. On paper, however, the financial weather has already turned, and the storm clouds are firmly overhead. Number 8. Denver, Colorado. We head northwest into thinner air. Denver rises ahead of you. Backed by the Front Range of the Rockies, a city that spent the last decade on nearly every list of hottest markets in America. Young professionals arrived in waves, remote workers joined them. Investors saw a safe bet. Breweries, bike lanes, and renovated bungalows became the visual language of a metro that seemed permanently ascendant. For a long time, it worked. The problem is that prices outpaced incomes year after year, and the gap has finally become impossible to ignore. Today, the difference between what the typical household earns and what they need to earn to comfortably buy the median home here is massive. For many families, the dream of owning inside the metro has shifted from hard to mathematically impossible. The Denver Metro Association of Realtors reports that active listings have surged to levels not seen since the early 2010 era. The number of available homes has more than doubled from the ultra-tight days of the pandemic. You can see it in established neighborhoods and in the newer master-planned communities on the edges of the city. Mortgage applications in the area have fallen sharply, reflecting buyers who have run into a hard affordability wall. Demand did not just slow. In key segments, it stepped aside. Would-be first-time buyers stay in rentals. Move-up buyers stay in their current homes to protect low-rate loans. Sellers are no longer getting everything they ask for. Close-to-list price ratios have slipped below 99%, which might sound minor, until you remember those ratios used to be above 100% with multiple offers and waived contingencies. Now buyers negotiate repairs, closing credits, and rate buy-owns, and they often get them. Inspection reports that would have been ignored in 2021 are suddenly powerful leverage again. The rental market is not providing easy cover either. With many would-be sellers renting out homes they could not offload, vacancies have risen and rents have flattened or dipped. That squeezes investors who counted on steady rent growth to justify high purchase prices. When rent does not support the math, the investment story breaks. Some are discovering that their cap rates no longer make sense in a higher rate world. Denver still has all the lifestyle perks that drew people to it. But the era when anyone could rely on automatic appreciation is over. In a city this stretched, even small shocks can trigger big shifts. The view of the mountains is still beautiful, but the financial footing beneath a lot of those rooftops is far less solid than it used to be. Number 7. Nashville, Tennessee. We turn back toward the heart of the country and arrive in Nashville, a city that for years embodied the South's housing success story. New residents streamed in from higher tax states, construction cranes filled the skyline, and neighborhoods like the Gulch and East Nashville became symbols of growth, trendy living, and seemingly endless price appreciation. Entire areas transformed almost overnight, and it felt as if Nashville could do no wrong. That momentum encouraged aggressive building. Developers spent years adding luxury condos and high-end homes under the assumption that cheap financing, population growth, and tourism demand would continue indefinitely. Now, many of those projects are hitting the market at the same time, just as mortgage rates have risen and travel spending has cooled. The skyline that once represented opportunity is now signaling oversupply. Local housing data shows inventory in the Nashville metro has surged more than 40% year over year, one of the fastest increases in the country. New construction is feeling the strain most clearly. Time on market for brand new homes has stretched well beyond normal levels, with many properties sitting 3 months or longer without a buyer. Those delays quickly erode builder margins as carrying costs pile up. To keep sales moving, builders are offering increasingly aggressive incentives. Large credits, mortgage rate buydowns, and design upgrades have become common. Some are quietly covering months of homeowners association fees or even furnishing units just to clear inventory. Short-term rentals are also under pressure. What was once marketed as a near-guaranteed income stream is now crowded and competitive. As more listings chase a limited number of visitors, revenue is declining. For smaller investors, the math has turned uncomfortable. Either sell at a discount or absorb ongoing negative cash flow. Regulatory uncertainty and neighborhood resistance add even more risk. Meanwhile, price per square foot growth has stalled and begun to edge lower. The shift may appear subtle, but for those who bought near the peak, even modest declines translate into real losses. The assumption that there would always be another wave of eager buyers is being challenged. Nashville is not in freefall, but the market has clearly changed. Supply now holds the leverage, and the city's housing story has moved from celebration to caution. Number 6. Seattle, Washington. We head back to the Pacific Northwest, under the gray skies of Puget Sound. Seattle's modern housing boom has been tightly linked to big tech. For years, stock grants, bonuses, and aggressive hiring at companies like Amazon and Microsoft poured fuel onto home prices throughout King County. Modest homes in close-in neighborhoods routinely carried 7-figure price tags, and buyers still competed. Seattle became the poster child for a new economy where high salaries seem to justify almost any valuation. That engine is no longer running at full speed. Layoffs, hiring freezes, and restructuring across the tech sector have reshaped confidence. Workers who once felt secure are now more cautious about committing to massive mortgages. Some have left the region altogether, seeking cities with lower costs where their money stretches further. Others are choosing to rent longer, prioritizing flexibility in case another round of cuts arrives. Regional housing data reflects that shift. Year-over-year sales volume has fallen sharply, with pending sales at multi-year lows. The pool of active buyers has thinned, and the effects are showing up in longer days on market and softer final prices. Homes in once red-hot neighborhoods are no longer flying off the shelf, and open houses feel calmer and more deliberate. Price trends confirm the change. Major home price indexes show Seattle among the fastest large metros to decline from its peak. In nominal terms, values are down, and when adjusted for inflation, the drop is even steeper. Equity that felt permanent in 2021 has proven far more fragile than many expected. The slowdown is most visible at the high end. Luxury homes that once sold within days are now sitting for months. Each additional week on the market increases uncertainty and often leads to fresh price reductions. Some sellers at the top are quietly revising expectations they once considered untouchable. Remote work adds another layer. With more tech workers able to live almost anywhere, Seattle is no longer the automatic choice it once was. Surrounding suburbs, once viewed as safe spillover markets, are also feeling the shift. Seattle remains economically strong, but its housing market is rediscovering a fundamental rule: even superstar cities cannot outrun incomes and confidence indefinitely. Number 5. Phoenix, Arizona. We head back into the desert heat, where Phoenix stretches endlessly in every direction. During the housing boom, this metro became a textbook example of what happens when easy credit and speculative money flood a market at the same time. Master-planned communities seem to rise overnight, each advertising resort-style living under the Arizona sun. Phoenix quickly turned into a favored playground for instant buying companies and large investors using algorithms and fast financing to scoop up homes by the thousands. For a while, those players appeared to put a solid floor under prices across entire neighborhoods. Today, that support is quietly disappearing. Drive through many suburban areas and you will still see corporate sale signs, but the strategy has shifted from aggressive expansion to careful retreat. Data now places Phoenix near the top of the nation for the share of listings with price reductions. Many sellers, both homeowners and corporate investors, have already cut prices once, and in some cases multiple times. As those reductions spread, everyday sellers are forced to follow suit just to remain competitive. Active listings remain well above levels supported by current buyer demand. At today's mortgage rates, there are simply too many homes chasing too few qualified buyers. Rising living costs compound the problem. In a desert city, soaring summer cooling bills matter, and higher expenses for utilities, water, insurance, and maintenance are stretching household budgets thinner than expected. Financial stress is beginning to surface. While foreclosures are still far below crisis-era extremes, filings are trending higher, especially among buyers who stretch to purchase near the peak of the market. Many of those loans were based on optimistic assumptions about continued appreciation that never materialized. Investor interest has faded sharply. Large funds and small landlords alike are pulling back, slashing purchase activity, and in some cases, selling properties to raise cash. What was once a powerful source of demand has flipped into an added stream of supply. Without instant buyers and heavy investor participation, the Phoenix market must rely primarily on owner-occupants. For a city where prices surged at extraordinary speed, that shift suggests a longer and more uncomfortable adjustment ahead. Phoenix is now confronting what happens when artificial supports are removed and housing values must align once again with real household incomes. Number 4. San Francisco, California. We return to the West Coast, where San Francisco faces more than a typical housing slowdown. It is undergoing a broad urban reset. Downtown streets reveal the shift. Vacant office towers, empty restaurants, and sparse tech buses replace the once bustling commute. The collapse in commercial real estate is far from isolated. It ripples through the housing market. When office occupancy falls and street-level activity diminishes, the value of nearby condos, mixed-use buildings, and centrally located older homes declines. Buyers who once paid premiums for a short commute now question the cost when offices are half-empty or fully remote. Sales volumes across the city have dropped sharply, and median prices, especially for condos, have fallen in double digits, erasing years of gains. Homes that would have sparked bidding wars just a few years ago now sit with repeated price cuts. Other factors compound the slowdown. Safety concerns, visible homelessness, and declining quality of life have pushed some residents to leave. Multi-year migration data shows a net outflow, shrinking the buyer pool and weakening the tax base that supports local services. Nearby suburbs absorb part of that movement, but many families are leaving the region entirely. Even luxury properties that once commanded record prices are now selling for millions less than peak values, resetting comparable prices across neighborhoods. San Francisco retains strong technological and cultural advantages, but its housing market is now entangled in a feedback loop of office vacancies, population decline, and budget pressures. Buying here today is effectively betting that the city can reverse these trends within a reasonable time frame, a risk many cautious buyers are not ready to take. The city's iconic charm remains, but the financial reality beneath the skyline has shifted dramatically. For homeowners and investors alike, the lesson is clear. San Francisco's housing market is no longer insulated from the broader economic and social changes reshaping the urban core. Number 3. Boise, Idaho. We head inland again, into a quieter landscape that tells one of the most striking stories of this housing cycle. Boise became the poster child of the remote work gold rush. Buyers from out of state, especially California, arrived with equity and cash, bidding up modest homes in peaceful neighborhoods to prices that stunned local residents. The Treasure Valley turned into a national symbol of the idea that you could sell a small coastal home and buy something larger near the river with money left over. For a time, it felt like a permanent shift, but the flow of outside money eventually slowed. At the peak, Researchers repeatedly flagged Boise as one of the most overvalued housing markets in the country, with prices far out of line with local incomes. As remote work demand cooled and out-of-state buyers pulled back, the market began to adjust. That adjustment is now clearly visible. Homes that once sold in a weekend are sitting through multiple open houses with minimal traffic. Local data shows median home prices down noticeably from their highs, with some measures reflecting double-digit declines. Inventory has expanded dramatically compared with just a few years ago, and sellers who once felt untouchable are now facing stagnant showings and repeated price cuts. The mood has shifted sharply from fear of missing out to fear of overpaying. New construction tells an even harsher story. Builders who broke ground during peak demand are now delivering homes into a much softer market. To move inventory and pay down construction loans, many are offering deep discounts, often $50,000, $80,000, or more off-list prices. Those discounted new homes reset comparable values across entire neighborhoods, instantly putting pressure on resale listings. One aggressively priced new build can undercut multiple existing homes overnight. Buyers who purchased near the top in 2021 or 2022 are already feeling the consequences. Paper equity has evaporated, and some owners now owe more than their homes would sell for today. Selling may require bringing cash to the closing table or accepting a significant loss. Others are choosing to stay put and wait, even if the lifestyle they envisioned no longer fits their reality. Boise remains scenic and livable, but its housing market is a powerful reminder that when prices surge far beyond fundamentals, the return to balance is rarely smooth. Number 2. San Jose, California. At the top of our list is San Jose, in the heart of Silicon Valley, long the pinnacle of American home prices. Here, modest-looking homes routinely trade for $2 million, and ordinary streets hide extraordinary wealth from stock options and tech salaries. For decades, the belief was simple. If you could buy in San Jose, the market would eventually reward you. For a time, it seemed like gravity didn't apply, but now the math says otherwise. Today, buying a typical home in San Jose often requires a household income approaching or exceeding $400,000 per year. That immediately rules out nearly everyone, even in a region packed with engineers and executives. Younger workers who once dreamed of Silicon Valley ownership are looking farther inland or out of state. Sales have dropped to some of the lowest levels in years, not because demand is too low, but because both sides of the market are frozen. Sellers cling to historically low mortgage rates, while buyers step back in the face of massive monthly payments. Inventory appears limited on paper, but the market no longer behaves like a tight one. Prices are sliding even with fewer homes for sale because the pool of qualified buyers has shrunk dramatically. Listings linger longer, and even the most desirable move-in-ready properties no longer spark frenzied bidding. Average monthly payments on new purchases now rival the cost of entire homes in other states, putting high earners under stress and highlighting the risk of tying so much income to a single asset amid tech layoffs and stock volatility. A deeper concern looms. If the tech slowdown intensifies, forced sales won't be small condos. They will be multi-million-dollar homes. A wave of those hitting the market could quickly reset comparable values, creating ripple effects throughout the region. San Jose represents the peak of the last housing cycle. Its struggles matter because when the summit shakes, tremors run down into every tier of the market. From the top, the view is still spectacular, but the footing has never been more precarious. The U.S. housing market is not one story. It is thousands of local narratives unfolding simultaneously. Number 1. Austin, Texas. We head south to Austin, Texas, a city once hailed as the next great tech hub. For years, Austin's growth seemed unstoppable. Tech companies relocated en masse, remote workers poured in, and developers raced to convert open fields into sprawling subdivisions almost overnight. The city's motto quietly shifted from "Keep Austin Weird" to "Keep Austin Booming." But when interest rates rose, the once blessed pipeline of new homes turned into a challenge. Inventory in the Austin metro now sits far above pre-pandemic levels. Thousands of new homes compete directly with existing properties, all vying for a buyer pool thinned by higher mortgage payments and a cooling tech sector. Master-planned communities north and south of the city show row after row of near-identical homes with signs offering incentives, price reductions, and special deals. Median sale prices have dropped from peak levels, with some measures showing roughly a 10% year-over-year decline. For buyers who purchased during the frenzy, that translates into substantial real-dollar losses in just a few quarters. The tech-driven demand engine is slowing. Many companies that fueled Austin's migration boom have paused hiring, slowed expansion, or shifted focus. Fewer high-salary workers entering the market means less competition at the margins. Homes that once drew dozens of offers now sit for 3 months or longer. Sellers respond with price cuts, concessions, or even decide to hold and rent instead, all while paying property taxes based on peak-era assessments that don't adjust quickly. Rental markets are softening as well. More units chase tenants, and average rents are dipping, undermining the investment thesis that assumed constant appreciation and rising cash flow. Some landlords experiment with midterm or corporate rentals, only to find those markets saturated too. Austin remains a dynamic, creative city with vibrant culture, music, and food. But its housing market is now navigating a classic boom and bust cycle. Anyone entering today must accept that volatility, rather than straight-line growth, will define the coming years. The skyline and lifestyle endure, but the math behind the market has changed. The 10 cities we've explored are just the early chapters of what millions may face later. The housing downturn isn't a distant storm. It's already hitting these zip codes. If this road trip helped you see past the headlines and glossy listings, tap like, share with anyone thinking about buying, and subscribe to Housing Watch. Drop a comment with what you're seeing in your area: price cuts, empty open houses, or rising inventory. We're reading your stories and using them to plan our next stop.